My talk today is obviously on silver and how and why I think silver is the new oil and the next uranium. And here we are. So let's get right to it. The first thing I want to talk about is recency bias. This is something that, if you're not familiar with the term, it means that we have the tendency, and I think especially as investors, to see the future much like the past. And that can work for a while, but if you're not careful, it can burn you. And we do go through transitions, periods of transition where things shift and we end up in a new paradigm. And I think that's where we are right now. I think we're in what I call an inflationary decade. And I don't think that things will look like the recent past. I think they are changing. And the thing with these transitions is that they tend to be messy. They take a while to play out. If you think about, say, the 1980 to 82 period, when you had a bottoming in stocks and a bottoming in bonds, both of those markets took off after that and were the place to be for probably 40 years. But if you look at how stocks and bonds performed over about a year to 2 years, it really was a messy period. They were moving up, moving down. People had spent, a decade and a half looking at these assets, and they had done basically nothing for them, especially, and if you look after inflation, stocks were down something like 70%, even though those indices had just moved sideways. So something to keep in mind is recency bias. I'm going to look at the financial picture globally. So global debt, this is info from Bank of America, reached a 224 trillion high record. So that's a lot of currency that's floating around in the system, and speaks to why I think precious metals have really held up. Gold has been tremendous. Yesterday closed at a new all-time high. I think that's a sign of what's to come. And gold has really held up tremendously in the face of the most aggressive tightening cycle in interest rates in decades. So there's been a lot of central bank buying. 2022 was a record year. 2023 was almost matched that record. And if you look at how much gold is supplied every year, it's about 4,700 tons. And central banks bought more than 1,000 tons every year, 2022, 2023. So that means central banks bought more than 1 out of every 5 ounces of gold in the last 2 years. So that's just tremendous buying and speaks to their commitment to gold. And I think what has driven a lot of that was not only their outlook in terms of inflation, but also what happened when the U.S. weaponized the dollar and froze Russian assets. So you have all these sovereign investors looking around and saying, they're perhaps friendly with the U.S. now. They don't want to get caught the same way, and are looking for an alternative, and gold has obviously been the answer for them. If you look at what we've, potential black swans, last year's bank failures in the U.S. that managed to be relatively contained, but yet it surpassed what you had in 2008, 2009 in a matter of a couple of months. So these kinds of things will come unexpectedly. That's pretty much the definition of a black swan. And gold and silver spiked in that kind of environment. And so I would think that, I don't think this is done by any means. I would keep an open mind to this kind of thing coming back to haunt the financial system. And precious metals tend to be a fantastic hedge against that. If you look at what's been happening with the U.S. debt, we're at record levels, about $34 trillion. Right now, 30% of that is going to mature within 1 year. So who is going to buy $8.9 trillion of U.S. bonds when they come due? Well, certainly not foreigners. We're at 19-year lows in foreign holdings of U.S. treasuries. So they've gotten the message. They're not interested in holding them. And with what the U.S. did, as I mentioned, with Russian assets, they're even less interested in holding U.S. treasuries. So what it means is that the Fed's likely going to have to step in and be a buyer of last resort, and that's going to just flip everything back to a lot more quantitative easing, and that's going to create even more inflation and support precious metals even more. Federal interest payments in the U.S. have reached a record now of $1 trillion. That's obviously exacerbated by high interest rates. even if they cut rates, we're not likely, that's not going to drop off. It's going to keep growing. It might grow at a slightly less aggressive rate, but expect that to continue to grow and the deficits to grow along with them. We were told that inflation would be transitory. Well, nothing here looks transitory to me in the last 3 years. If it really was transitory and if it was caused by supply chain issues, a lot of that's been resolved. When you have supply chain issues and they're resolved, prices should come back. They may not come back to what they were exactly prior, but that you should see a marked drop. That certainly has not happened. So I think that inflation is staying with us. It's here to stay. If you look at the 1970s, we had 3 waves, successive waves of inflation. I think what we've just been through is going to be the beginning of what we lived through in the 1970s. Now, here's an example of what I'm talking about with recency bias. This is Canada's inflation rate from 1992 until 2022, so 30 years. And that's pretty stable, right around 2%. And if you pick any 6 to 12-month period in there, you'd have a hard time finding anything much above or much below 2%. And then what happened? Then you had COVID hit. That was that black swan, and you had this spike in inflation. Took a lot of people by surprise, and that's what I'm talking about again with recency bias. It's very dangerous to expect the future to look like the past, and I think more so than ever in this kind of environment. Now switching to the resource and commodities side. The last 4 commodities bulls were inflation driven. That goes back a century. The most recent one, which was in the early 2000s, was driven by a China manufacturing boom. I think that we're actually going to see a new resource bull market. I think this one's going to be driven by inflation again. I'm not quite convinced that it's going to be a demand-driven bull this time. I think that at the very least, the first part of it is going to be more of a supply-driven resource bull. There's going to be continuing lack of supply to meet sort of regular demand, and that's going to help drive the market. I think that when you get a lot more support, fiscal support and monetary support from central banks and from governments, providing liquidity once again when you make your way through a recession, that's going to help drive the demand side of it further. Looking at gold, how gold has behaved in rate topping cycles. So arguably, we are not going to see more rate increases. And each time we reached a peak in rates, it's easy to look back because this is historical. On average, in the last three cycles, when we reached a peak in hiking, gold averaged about a 50% gain after that. So that's really pretty bullish. You look at what investment advisors are doing. In the US, 75% of investors have less than 1% exposure to gold in their portfolios and in their client portfolios. Just to get back to normal, this would probably be up 5 times. So that speaks to the potential that you've still got ahead of you in the precious metals market. This is a chart I put together that I wanted to look at how silver behaved when the Fed started hiking rates, and it did it, as I say, very aggressively. So that green line marks when the Fed started hiking rates in early 2022. The blue line is the silver price. Well, of course, within a matter of months, silver started to come off and then moved back up. And if you've got a pretty reasonable range where you've got silver really holding up quite well after the Fed started to hike rates pretty aggressively. So that shows to me that it's actually been really quite resilient and obviously moved up a step higher from prior to COVID and has maintained these higher levels. And then I put this chart together looking at what happened when we saw what gold did when the Fed stops hiking rates. And I said, let's look at what silver does when you're at the end of rate hiking cycles. Well, silver follows with a lag. It does not start to perform when you reach a peak in interest rates. It really starts to take off after the rates start to get cut. And that's about, again, we can look at this historically, about halfway through the rate cutting cycle, silver takes off. It's actually in the last 3 rate cutting cycles, it's averaged 413%. So that speaks to the phenomenal potential that the metal has going forward. Give you an idea what's going on elsewhere. Turkey is suffering 65% annual inflation. And if you look at this chart, its imports of silver have been soaring. They doubled prior years in the last couple of years. People have traditionally been turning to gold. They've found that too expensive, so they've turned to silver. Silver is the natural alternative to gold when gold really starts to take off for multiple reasons. Obviously, it's a lot more affordable on a per ounce basis. This is the price of silver in Turkish lira. 3 years ago, it was $100 lira per unit. Now it's 700 lira per unit, so it's up sevenfold in a matter of 3 years. In Egypt, it's a similar story. In Egypt, it's a tradition to buy gold for a bride. It's a tradition to buy gold for a newborn. And they've actually started to turn to silver as well. They've found that the gold has just become too expensive. So they're starting to call silver the new gold in Egypt. And in the last year or so, the price of silver has doubled in Egypt. Now let's switch to the industrial side of silver. Solar is really the 800-pound gorilla in the silver market. It's really driving industrial demand. Just 4 years ago, it was about 100 million ounces. Next year, it's already forecast to be over 200 million ounces. So just tremendous growth coming from just solar alone. That's 20% of all the silver that's supplied every year is going just to one application, not just industrial, but one application period of all uses of silver. Now, this is a bit of a wake-up call when it comes to expectations in silver. So I thought it'd be interesting to look at what forecasts were for silver and what the reality ended up being last year. So first one is supply forecast. Overall supply between mining and recycling was forecast that the supply would be up 2%. Eventually had to be revised down. So silver was actually, overall supply of silver last year was down 2% in the face of surging demand. Industrial demand for silver forecast was up, was for demand to be up 4%. It was revised at double that, up 8%. The solar demand alone for silver was forecast for last year to be 140 million ounces. That ended up being revised at 190 million ounces. That's more than 30% underestimated. Supply deficit last year for silver, the forecast was 142 million ounces. It ended up being revised at 194 million ounces. Again, more than a 30% underestimate for silver. So the Silver Institute thinks these deficits are going to continue. These structural deficits are going to continue for years going forward. But then you ask yourself, why is the silver price flat in this kind of environment when we're facing these large structural deficits? And here's what I think is the answer. You've got a lot of what I call secondary silver that's sitting in ETFs, physically backed ETFs, and on the futures exchanges. And if you look at what's been happening in the futures exchanges, there are three main exchanges: the COMEX in the US, then you've got the Shanghai in China, and then you've got the LBMA in London. Overall inventories are down on average about 30 to 40% across these four exchanges. That's all the silver in those exchanges. Similar action in London, similar action in Shanghai. And then you see silver holdings into ETFs. Those have come down as well. So I think what's happening is that you've got these large industrial players are buying long futures contracts. They're buying silver ETFs that are backed by silver, and then they're just standing for delivery. And they know that the silver is sitting there. It's a way to get the silver at the current low, undervalued, I believe, spot price. This is a summary of it, but what's interesting is there's silver on these exchanges, and then there's registered silver. And registered silver is the silver that's actually available for delivery. So if you hold a long contract, that's what you need to be looking at. How much of the silver on that exchange is really available for me to take delivery of? And that's a small portion of the overall silver held at the exchange. In Shanghai, registered silver is down 73%. On the COMEX, it's down 70%. At the LBMA overall, it's down 32%. So now, relative to commodities, this is a chart that goes to about a year ago or so. It's not all that different. We know that commodities have struggled in the past year or so, but if you compare how silver has behaved to commodities overall, silver has not kept up with the rally in commodities. So there's this disconnect and a lot of room for silver to play catch up, and that again speaks to the opportunity. I like to say that silver is a patience trade. It's very much like how we've seen Bitcoin over the last few years, uranium as well over the last few years. It goes through these long periods of moving sideways, really not doing a whole lot, and then all of a sudden it just explodes higher. In the last 6 months or so, we saw Bitcoin double in price. We saw uranium double in price. And here I thought was an appropriate quote from Rick Rule. He said just last month, "The silver equity market resembles that of uranium in 2022. It's stupidly cheap." So that's something I'd like to leave you with in terms of thoughts of where the silver market is. I published this book in May of 2022. This is really a way to get an introduction to silver and what I believe is an opportunity in silver, a generational opportunity. You don't get these kinds of bargains forever. Really, silver does catch up very quickly when it does. So that's a way to understand the silver market, the history of it, and how silver performs, how to build a portfolio in silver stocks. I publish Silver Stock Investor. It's the only silver-focused investment newsletter, and I cover the space from physical all the way to junior explorers and everything in between, and I publish it twice a month. It's my thoughts on the macro landscape. I have proprietary research on silver market drivers. I look at technical chart review of financials, the dollar, silver, and silver equities. And then I have regularly new recommendations that I research, and then I publish, as I say, updates on the entire portfolio every 2 weeks. So you can follow my work at silverstockinvestor.com. I'm on Twitter, pretty active there, at Peter_Krauth, and I'm on LinkedIn. And I'm offering a 30% discount on anyone who wants to take up an annual subscription. Anyone who's here today, you can use the QR code. You've got a minute or two if you want to take a shot of that. And if the other ways, you can go to the website. It's Resource Maven and Silver Stock Investor, and you've got the code there that you could put in, which is 30 MIF 2024 SSI. And that is it for me. Thanks very much.